Good morning. It's Wednesday, June 22nd. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights. And this is your Daily Five. Today, we are going to address a couple of important questions. Number one, are we already in a recession? Let's jump right into it. Slide number one takes a look at what the Atlanta Fed publishes, known as the GDP Nowcast. And their GDP Nowcast actually looks quite ominous. Recall that first quarter 2022 GDP was revised down to negative 1.5%. That's a contraction. And that compares to a 7% annualized rate in the fourth quarter of 2021. So quite a collapse of almost epic proportion. Now, what the Atlanta Fed's GDP Nowcast is suggesting is that real GDP growth remains quite weak and that the second quarter's annualized rate is now estimated to be zero. Now, they will update this again next Monday with the latest data points. And it looks like those data points are poised to come in poorly. And so in our view, the real risk here is now to the downside with a very high potential of second quarter or second consecutive quarterly GDP contraction in Q2. And as most already know, as a rule of thumb, 2 consecutive quarters of shrinking economic output has long been associated with every past recession. So we need to be on the lookout and potentially brace for a hard landing here. Now, if in fact we do get a second quarterly contraction in GDP, how is it going to look? Let's take a look at slide number 2. This is a bit of a roadmap that I think we can follow to kind of see where we are in this process. And the real question that I have is simple fact that we're already checking off 5 of these boxes, across the housing and new order side suggests to us that we are in fact in at least something of a rolling recession. The slope of hope here first points to housing rolling over, and we've seen pretty strong evidence by declines in the NAHB confidence surveys. Mortgage applications, were atrocious last week. They're up a little bit, but it's mostly adjustable rate mortgages this week, and new permits have collapsed. And so, housing's already in disarray, and that's the tip of the spear. The second here is new orders rolling over. And we're seeing, pretty devastating data coming out of the ISM right now. And consumer confidence is measured by the Michigan survey, hit an all-time record low in the 45 years of its history. And it's usually, consumer spending follows consumer confidence with about a 1 to 3 month lag. So we should start to see a slowdown in consumer spending in the not too distant future. Third is profits rolling over. And, we'll know that that's happening by evidence of declines in manufacturing sales, declines in capital goods spending, declines in industrial production, and ultimately lower forward guidance and downward earnings revisions, which I expect we'll begin to see in, epic form in the second quarter as conference calls kick off in mid-July. But we've already heard from Walmart, Target, Microsoft, Salesforce.com, Intel, just to name a few, that have revised guidance lower. And if these big, gigantic companies that have lots of financial flexibility are having trouble hitting their expectations, it seems to me that the smaller firms are really going to be caught offsides here in the second quarter. So I think we need to prepare for significant downward revisions in earnings. And then fourth, unemployment. Unemployment's the last thing to feel this, and we'll know that it's finally occurring when we see lower average hours worked, when we see lower non-farm payrolls, when we see lower personal income, and this finally, we'll see a downtick in the CPI, a substantial downtick in the CPI. It's really the last thing to inflect. And so The time horizon here has traditionally been 1 to 24 month time horizon, and it looks to me like we're at an accelerated pace to begin recession. We won't actually know if we're in a recession until the National Bureau of Economic Research reports it, and they usually don't tell us until after the recession's over, and then they look back in history and they'll date it. And oftentimes that's 12 months from the point where the recession actually started. So it would not surprise us one bit to find out as we move into 2023 that we've been in a recession all this time. But let's take a look at what is happening to earnings on slide number 3. I think the next shoe to drop here are big earnings revisions to the downside, as I mentioned. And what we're looking at here is a chart of earnings revisions breadth. What does that mean? Earnings revisions breadth is the difference between the number of company forecasts that are seeing upside revisions versus those seeing downside revisions. And what we saw recently is that this aggregate S&P 500 earnings revisions breadth number just went negative for the very first time in a long time. It's been in a downtrend since June of last year. So certainly we've seen this muted environment for earnings at this point. And aside from energy, looking at it from a quarterly perspective, and you can see the small insert in that chart where the sectors are highlighted. Energy is really the only sector that's seeing strong revisions to the upside. Materials, financials are holding in there. Industrials, real estate, and information technology, as well as utilities, are all teetering on the brink of going negative, and that's not good considering that info technology is the largest sector in the S&P 500. But what's really interesting is that consumer discretionary, healthcare, communication services, and staples are all already negative, and 3 of those are 3 of the 5 biggest sectors by market cap in the S&P. So we're definitely on the road to perdition here. What I see as a real problem is that consensus estimates are still actually going up. According to IBIS, the consensus is looking for S&P operating earnings to come in at 229 this year. That's up 10% year over year. And then for 2023, they're looking for another 9.8% growth to 251. We see a very high probability that those estimates will be revised materially lower. We have gone out in the public square recently with our estimates for 2022, and we're actually looking for earnings to be down, earnings per share to be down 5% this year when all is said and done. We've published a $198 estimate, so we don't think that earnings will be up this year. We're looking for a sub $200 number, and we're looking for another 3% decline in 2023. And that's based on doing a lot of work on revenue and margin growth in prior environments of inflation and rising interest rates. And it really does have a big impact. So our numbers are well below consensus, and I think these estimates are going to be revised down materially. So what does this mean for the market? A lot of people are out there talking about a low. And if we move to chart number 4, I just want to kind of dig into this whole notion of, has the market bottomed? We got a nice big rally yesterday, a little bit of follow through today after a sell-off in the futures overnight. But, what I'm looking at here is 2 big composites. On the left-hand side, the New York Stock Exchange composite of around 2,200 listed issues. And then on the right-hand side, we're looking at the NASDAQ composite of about 3,600 over-the-counter issues. So in aggregate, almost 6,000 stocks that we're talking about here. Historically, when the market hits these big turning points, we see a divergence between price in these index composites and their advanced decline lines. In other words, advancers less decliners. And we could see that actually if we go back to the January high in the NYSE composite, and we saw a negative divergence in the NYSE's advanced decline line. That signaled that top was likely a turning point, or we were very near a turning point. What we're seeing today is a confirmation in the low. So as the NYSE composite made its low last week, we saw the advanced decline line confirm that low. There was no divergence. If that low was likely to be a significant or durable tradable low, we would likely have seen a higher low in the AD line, a divergence, which we did not see. Now, if we look at the NASDAQ composite, the exact same conclusion can be drawn. We saw actually the NASDAQ peak back in November, and we saw a negative divergence in the NASDAQ's AD line. Last Friday, when the NASDAQ made its low, there was no divergence in the NASDAQ's AD line. It confirmed that low, and that tells us that we are not at, very likely not at a durable low just yet. So where are we? Let's look at chart number 3, and I think that will shed some light on it. Chart number 5, I'm sorry. Chart number 5 illustrates how we view the S&P 500 today through the lens of technical analysis. The S&P 500 has what we would describe as a major top formation. This is a classic pattern top of the head and shoulders variety. And that head and shoulders pattern has a weak right shoulder, which in a sense gives us this descending neckline, which suggests that we're going to have more downside volatility from this pattern. And the breakdown below, what we would define as, key support, chart support, neckline support around 4,200 counts to about 3,500 on the S&P 500. Now, we clearly breached trend and moving average support levels. We've clearly breached chart and neckline support, and we are breaking down below the 38.2% retracement level and holding. The next stop is really this 50% retracement level, which coincides nicely with the 200-week simple moving average and a couple of key prior closing weekly highs from back in August and November of 2020. So when we put all of these 4 data points together, we've got a pretty high probability that 3,500 is a reasonable target for support. Now, one of the things that we've been giving a lot of consideration to is the simple fact that there doesn't seem to be any reason for support. And oftentimes you can hit these levels and you get a bounce, but the bounce is kind of a failing bounce. And so, our fear is that we cut right through that support level like a hot knife through butter. And then what? Well, the stretch target that we can see would be the 61.8% retracement at 3,200 or so on the S&P. And that actually coincides with the September 2020 low and also the May 2020 weekly closing high. And so, we've got some secondary support that we can look to at around S&P 3,200. The only thing that would really change our mind about, this, expected market mayhem ahead is a sustained recovery above that S&P 4,200 level. That would call the immediate bear case for stocks into question. But based on the economic outlook and the rising interest rate environment that appears to be baked into the cake at this point, I think that's a very low probability. So we would be targeting 3,500 initially, then 3,200 as a secondary stretch target if 3,500 fails. With that, I want to just roll to our contact information and let you know that you can get more information on the work that we're doing at my website, www.jwh.com. On that website, we publish a free newsletter each month. It's called Huge Insights. You can sign up on the website and subscribe to it, so it's delivered to your inbox on a monthly basis. And we've actually got a members product there as well, where if you're really interested in our work and you want to see our top ideas, you can become a member for like $10 a month, and we'll send you our top trade idea each week. We usually publish on Wednesday afternoons, and it's usually a stock or an ETF, and we track the performance, and it's been pretty good. So take a look if you're interested in idea flow. You can also follow us on Twitter at alpha_insights. And we're on OETV under Alpha Insights in the OETV research marketplace. So with that, I want to thank you for your time today. And as always, good luck trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.